So first of all, let me give you my impressions of Powell's testimony before Congress. He was on Capitol Hill. It used to be called the Humphrey Hawkins testimony. And what got my anger up a little bit is he was doing a victory lap over inflation. You know, it's very political. The questions that these congressmen and senators ask is so ridiculous. Most of them, 99% of them. But he's doing a victory lap on inflation, and I got to thinking, wait a second. I went back and looked at the data myself. So the Fed has an inflation target of 2%. And I'm going to answer your question, by the way. So let me just set the table for you. Because inflation hits me right square in the eyes here, because I have to start my conversation off with inflation. So the Fed has an asinine inflation target of 2%. They have been above, and that's average inflation. So it can be a little bit above that, a little below that, but it should average 2% over time. The Fed is doing a victory lap over inflation, even though the rate of CPI has been above 2% for just 2 months shy of 4 freaking years. North of 2%. And he's, crowing about having inflation fall from 9% to 3%, even though it's rising faster and further away from his 2% target. But here's the main kicker, is that inflation has already bankrupted the bottom 3 quintiles of consumers. And in fact, I actually did some shopping this morning, Julia, for our show. and I'm looking at there's prices on things, and I'm not just talking about eggs, that I have never seen before. Now, it doesn't really bother me that much. The 1%ers don't really care as much as the people that Powell professes to care the most about, which is the poor. He's destroyed the purchasing power of the currency against hard assets, but also against houses and eggs and energy and insurance. So it's so sad, and that brings me to the point that I'm trying to make here about where we are sitting here. We're sitting at a position where the $5 trillion that the Fed printed post-COVID is kept the bubble afloat. It's kept real estate afloat, it's kept the equity bubble afloat, and it has kept the credit bubble afloat. But that liquidity is slowly draining, and I'll give you an example of what I mean by that. So the Fed created something called the reverse repo facility. It's another way of the Fed to take back some of the reserves and pay the banks interest so they don't loan them out and create hyperinflation. We only had 9% inflation, not hyperinflation. But the reverse repo facility at one point was $2.3 trillion. Today it's $67 billion. So that is money coming out of the reverse repo facility, which is the money was laying fallow with the Fed, getting interest for the banks. The banks took that money and bought treasuries, and that's new money supply. A constant flow of QE coming into the economy. That's almost gone. But then I think about reserves in the system. Total reserves are over $3 trillion. They were almost nothing prior to the global financial crisis. Those reserves have to come out of the system. So you're having a lot of liquidity boosting the top, 1 quintile. Top 20% of consumers who are looking at their stock portfolios and looking at their real estate portfolios and say, wow, this is great. But as that liquidity comes out, it's like the hot air balloon is getting deprived of that lift. The air is getting shut down, and that balloon is going to crash. And that's a triumvirate of bubbles that will absolutely crash. Do I sound like a Cassandra? Well, maybe. Do I sound like a broken record? Well, maybe. But listen, I manage money for a living. I am not short the stock market yet. What I'm doing here, Julia, is I'm warning your audience that these a triumvirate of bubbles, credit, equities, and real estate, will crash from record levels soon. I don't know if it's, next year or this year. I don't know. But it will crash. And if you're not prepared to invest in a way that gears your assets towards depressions and deflations, and then intractable inflations at different times, because that's what they're going to do. They're going to suffer, I think, a deflationary depression, and then the Fed's going to come in with the Treasury to try to reflate the asset bubble because they have no choice. Once the money markets freeze, they have no choice. And you have to gear your investments towards that dynamic of busts and booms in that the dynamic between inflation and deflation. It's nice that I say that we're in a bubble. Well, what the heck what's your evidence? What evidence do you have? Well, let's start with one metric. You look at the total market cap of equities as a percentage of GDP. It is well over 200% as we record this interview today. Now, the normal metric there, that normal ratio, is below 100%. It was just above 100% prior to the global financial crisis. It was 135% at the peak of the NASDAQ bubble before the NASDAQ lost 80% of its value. We're now well over 200%. And that's not the only evidence of an equity bubble. If you look at price to sales on the S&P 500, a record high. If you look at the risk premium, which is the inverse of the PE ratio minus a safe asset like Treasury, it's negative. You get paid more to have a safe investment like a U.S. Treasury than you do on the earnings yield of stocks. The number of the family's allocation, so investors' allocation, American allocation to stocks, is at a record high, 64.5%. So that's the record high percentage of their assets own equities. Never before has been that high. In fact, I take that back. Only one time in history was it this high, and it was in the year 2000. So there is a massive and unprecedented equity bubble. Now, we've had equity bubbles before, not quite this big, but they've existed in isolation, Julia. But then when you combine the real estate bubble, if you look at the home price to income ratio, it has never before been this high. And then when you throw in insurance and taxes and maintenance costs, the ability for the average American to own a house has never been further out of reach. Now, we've had real estate bubbles in the past, in the aughts, circa 2006. That asset bursted, mortgage-backed securities collapsed, and banks went bankrupt. Home prices dropped by 33%. But it was a real estate bubble, not an equity bubble, not a credit bubble. And now you have those two bubbles, and you add the credit bubble. If you look at the total non-financial debt of the United States as a percentage of GDP, it's 265%. It has never been higher. If you look at the record amount of junk bonds that have been issued, the record amount of things like never even existed before, like private credit. You're a business and you can't get a loan from a bank, and you can't float debt. You can't borrow money in the bond market. You go to the shadow banking system and ask them for a loan. And then that's packaged up and sold to Wall Street. It's illiquid. It's non-transparent. But that industry has ballooned from basically zero to $1.5 trillion worth. There's a credit bubble, an equity bubble, and a real estate bubble. If you look at the mean reversion of those things, and I think they will burst concurrently, I think that you're looking at a 50% correction at a minimum. Now, I'm not saying it's going to happen now. Again, Julia, I manage money for a living, and I have no shorts in my portfolio. I only have one tiny short. It's a high yield short. It's about 1% of the portfolio. I'm long, I'm diversified, but I'm cognizant of the fact, and I have a model that predicts when I need to understand when the liquidity becomes a problem, when that liquidity is drained. And as I just mentioned to you, the reverse repo facility, a big part of that liquidity is already gone. I don't know how much or how many reserves are needed to keep the financial system floating. Like I said, there's like there's a little bit over $3 trillion in reserves. It certainly isn't below 2. So maybe it's the year. These reserves are coming out of the system. The Fed's balance sheet is shrinking. They're destroying base money supply, which is the building blocks of all monetary aggregates. As that money gets drained out of the system, you will see a problem in the repo market. You won't be able to float commercial paper. The market will start to crash. That might be engendered by a housing crisis. It might be engendered by an equity crisis. They're all going to crash pretty much simultaneously. So I think of liquidity, I think of the level of real Fed funds rate, which has been positive for well over a year now. That has been very significant in the past. When borrowing costs are negative, like they were for 10 of the last 14 years, that tends to get investors to say, well, let me just borrow money in the bank and just buy something, like a house or gold or the stock market, anything, because I'm borrowing for less than the cost of inflation. So it's an easy calculation. But when money has a real cost, it tends to dry up the impetus to borrow money. So that's one thing I'm looking at. I look at the reverse repo facility. I look at the reserves in the system. I look at the Treasury general account. So I have a 20-point model that measures and maps this liquidity. I look at the bank lending standards. What are the banks doing with the reserves that they have in the system? I look at the copper gold ratio. So there's, like I said, 20 components to my model, and that makes sure that I'm on the right side. I look at credit spreads. I look at financial conditions, and it's a really thorough and somewhat arcane puzzle that I put together to let me know what is happening regarding the second derivative of inflation in the context of growth. And when you have the market run into problems, it's usually derived from recessions or liquidity crises. That's when you really need to get the heck out of harm's way. Mm-hmm. And this is exactly what this model does. It lets me know when we're going to have a protracted and investable decline in the stock market. Most recessions in the past have averaged a decline of 35 to 37%. That's the average decline. Some have been 50 and some have been 80, depending on the index. I have no reason to doubt that the market will correct by 50%, just to bring it back into some kind of normal historical mean. But there are people who think that the Fed can just rescue us by returning to QE and ZIRP, and along with the Treasury, just print up a bunch of money. But here's the one thing that's changed since 1981. We finally have a real problem with inflation. Like I said at the start of the program, inflation has already bankrupted the bottom three quintiles. These people are very much suffering. They're finding it difficult to heat their house and to put shelter over their heads.